before I jump into the other Greeks and all kind of things nobody cares about, let's just look at this. So this is my screen when I want to buy an option. All right, now it's exciting. You're like, okay, what are all these numbers? And you're going to understand why we're doing this. It's because here, look, I'm going to show you, oh, this is a call, this is a put. But honestly, it's so small, you don't even look at it. But you know this is a call. Why? Because here, when the stock price, when the strike goes up, you see that the price goes down. And here, you know it's a put, because when the strike goes up, you see that the price goes up. It is the sensitivity we're talking about, all right? This was the sensitivity to the strike. And we're going to look at it now. And you're going to be like, oh, okay, but this is why it's so important. And so this, we're going to look at it. And then we're going to look at something else, that's the theta, and something you're going to tell me, oh, it's so boring. But it's so important because, look, it's what we said also. Here, the maturity is March. Here's January. All right, here it's a call. So here it's January. Forget about this one for now. When you have more time to maturity, because your stock has more time to go up, you pay more for the same option. So let's say this one strike 134. You find it here. Well, here you pay 11. Here you pay 18 to buy it. So it matters because when you look at the numbers, you know if it's a call or a put. You see that here your strike is higher. So when you plot your relationship like that, if the strike is higher, your payout becomes like this. So the same stock price pays less here than here. And so here, when it goes up, the strike, it should pay less. So this is a call. And it's important because sometimes people make mistakes. I'm sure some people did. I've seen things like, oh, I thought I was buying a call, or I think I got a put, why did it go down? All kind of things. So this is important. You need to understand what you're buying. If you don't know what you're buying, here it's so small, like no one is going to see it. You need to understand the sensitivity. All right? So this is one thing. You need to understand, okay, you pay more because you have more time to maturity. And one last thing you need to understand is which one you pick. All right? So what you can see is that when you're like very far from your stock price, here the difference, all right, this one is pretty liquid because it's NVIDIA, so honestly it's fine. Here you see that the difference between the bid and the ask is 0.15. But here it's 0.10 because everything close to the stock price is more liquid. So what this means is that here market makers take more margins. And why they take more margins? Because of all the sensitivities we saw before. Anyways. And so for optimal hedge, they take more. All right. And this is important because sometimes you're going to see gaps that look like $10. Okay, I'm going to exaggerate it a bit, $20. And clearly this means that if you send a market order, you're paying, the gap here is $12, between both. So when you send a market order, you just hit the other side. And this, I'm going to cover it in the next video. What is the bid and what is the ask, if you're curious more. I'm sure many people know already, but for those who don't, let's just look at this very quick.